From Citi. We're going to be talking about the strategic thinking around embedded finance and some of the opportunities out there in the market. Vivek, over to you. There'll be a
For the previous session also you were moderating?
Yeah, two moderations.
Okay. Can you guys all hear us okay? A quick show of hands. All right, perfect. Great. Okay. I'm not sure if anybody has seen that meme that's going around AI, generative AI. Somebody took a certain tech CEO's speech and pulled out the number of times that he spoke about AI and generative AI. I've been here for the past couple of hours and my brain is buzzing around finance, embedded finance, embedded finance in the similar manner. But hopefully this session would be something that will be less of the buzzwords and hopefully you'll take something away from some of this session. So, well, that was supposed to be the coffee beans that you smell before you get back to the perfumes. So let's get back to the conversation on embedded finance once again. So we have a great panel today with us. Many of you know them. They have been on the stage a couple of times before. But I want to start off by requesting you guys to introduce yourself, but with an addition of what is the role that you play in this embedded finance ecosystem. Maybe we'll start with you, Neeraj.
Hi, I'm Neeraj. I represent Policybazaar. We are a financial marketplace focused on insurance as well as credit products. Our objective is to make it more transparent for the consumer, give the power to the consumer to choose the right product, and make it a lot more easier for him to or her to understand. And I believe as a role the company plays in this region is again simplifying the financial space for a common man. And also on the insurance side, it is more on the making it more protection oriented. On the credit side, how do we ensure one, get a lot more credit awareness for consumers? In the sense, if you look at this market, this is a very plastic heavy, over leveraged market from a consumer perspective. So we are helping consumers understand their credit scores a lot better and as a result provide the right products.
Thank you. And to spend a bit more time specifically around embedded finance, you, if I'm not wrong, play the role of the distributor or as an embedder, what we'd call it. Why don't you explain to the audience what that effectively means for embedded finance?
So, okay. So from an embedded finance, so the most important aspect is I believe a lot of people don't understand what embedded finance is, right? Arjun and we were speaking the other day. I believe if I speak to a lot of people here, everybody's going to give me a different answer, and probably we might also give a different answer to what embedded finance is, right? One of the most important aspect I believe for us is embedded finance is doing stuff for us at least, which probably might not be the core, but it enables my core business to do well. For example, we do a lot of insurance policies. Now we get consumers who do not have digital ways of making payment. Now can I, using a banking solution, make him or get him a digital solution through which he can then pay for the policy that I sell is one of the embedded solutions, right? Or the easiest is probably the payment gateways that everybody uses at e-commerce. Payment gateways is not the core of, for example, Amazon. Payment is important to get the product finalized and everything, but that's not the core, right? Obviously, Amazon has started a payments company, but essentially in e-commerce, payments is one of the ways which facilitates the core. And that is where embedded finance sits, right? And we work with a lot of partners in being the embedded player for them. So for example, a second-hand car dealer marketplace, we will provide the insurance for them because insurance is not their core, but becomes important for them to sell a second-hand car. So that is how we start to play a role.
Thank you, Neeraj. Maybe Kelvin to you.
Yeah, hi everyone. My name's Kelvin. My claim to fame is that I built the global banking as a service business for Standard Chartered Bank. Started 5 years ago before embedded finance was even a part of the official lexicon. We used to call it platform banking. It's live in Indonesia, it's live in Malaysia with multiple partners, and it's going to a few other countries. Following which, then the role I play now is we've taken the technology that we built for Standard Chartered globally for enabling a full banking as a service offering, and we put it into this new company called Audax. I'm now the CEO. We've been live for about a month, and we are basically offering this technology as a solution for all banks. As banks go on this journey of embedded finance, they're going to find out that legacy systems are not going to cut it. This is an easy way to get to market in a short period of time.
Thank you. Arjun?
Great, thank you. So I represent a consulting firm. It's called R30 Little. Apologies, I don't dress like a consultant. I've been actually quite fortunate to have worked on the other side of the coin, if you might call it. And I think, as Kelvin just mentioned, we were trying to do embedded finance before the term embedded finance came around, and I think Vivek would know that too because we worked together about 6-7 years ago with Citi on that. So that's a bit of introduction. I should say that it's a complete honor to be sharing the stage with you two gentlemen. I'm a big fan of Policybazaar. I think the work Kelvin and audax is doing is brilliant. So I'm sort of humbled to be here. I'm going to sit back and learn. So don't ask me too many questions, right? But in terms of embedded finance, so here's my sort of 30 seconds on it, and I'm going to wear a non-consulting hat. Sorry, first let me tell you what I tend to do for a living. So I'm very passionate about the topic of fintech, particularly the topic about embedded finance, and I work with players from across the value chain, whether it is the regulators, it's the incumbent financial institutions, whether banks or insurance companies, the facilitators or the fintechs in the middle, or actually the embedders, right, who are taking embedded finance and actually bringing it to life. And what we're trying to do is demystify this whole concept of embedded finance, trying to work with the different parts to actually ensure that they're able to do something that is net incremental value generation, or it's a defensive strategy, whichever way you want to go about it, right? Sorry, now coming back to sort of my 2 cents worth, and I do say it is no more than 2 cents worth because they're just words, and words are worthless in most occasions, right? I think people misunderstood embedded finance to be something as simple as Apple Pay, right? Apple Pay is a great example of embedded finance, don't get me wrong, right? But it's not as simple. As you start to progress beyond basic in-app payments, largely in an e-commerce world, which is less than 20% of your B2C commerce and less than 5% of your B2B commerce, embedded finance starts becoming much more complex. So the first thing here is potential is huge, understanding is limited. Not trying to blame anybody for it. We're all on a learning journey. I think we're all discovering the power of embedded finance, right? Third thing from my perspective, I think Neeraj obviously mentioned, and I am wholeheartedly sold on that concept, that when an embedder, and I would not like to call them the distributor because I have an issue with calling them a distributor because that's not what they are. Distributors can be bank branches. Distribution, the whole point of distribution is I take this product and I just find another channel through which I can shovel it out. That's not embedded finance. A little bit of that can happen, but that's not embedded finance, right? Embedded finance only becomes true to Policybazaar when they can actually get greater sales. They can get more frequent customers. They can reduce their cost of customer acquisition. They can actually get more frequency. So it's actually got to be of material impact to them. Yes, on the side, if they are able to make some incremental income, we'll take it, right? I think that's one part. Last aspect is that there is the flip side of the coin of embedded finance, which is the as-a-service industry. So whether it's banking as a service, insurance as a service, wealth as a service. that is actually quite a complex equation, right? Especially in the context of the Middle East, where banks are making 2.5 times more money on an average compared to their global peers. Why would you want to introduce that level of disruption where you potentially need to depend on third-party geniuses like Kelvin, right, who you might not know very well? You understand his genius, but there's a risk associated. So I think for embedded finance to truly realize its potential, I think a lot of small parts have to come together, right? That's my 2 cents worth, but back to you, mate.
I think that sets the stage perfectly well for our topic today, which is a talk with the masterminds who we have here on designing and implementing an embedded finance strategy. And who best to talk about than somebody who is in the process of doing it, somebody who's supporting banks and players in doing it, and somebody who's guiding them to do all of that. And then I can just ask the questions, right? So let's start off with that, to the point that Neeraj, you spoke about, and Arjun, in your past life when you tried. What is the need or the opportunity which anybody should be looking at to really think about, am I or is my company, is my startup ripe to now get into an embedded finance opportunity or a need? Maybe we'll start with you, Neeraj.
Hey, you go first, sir.
I believe great question from a perspective that I believe everybody wants to get into it without realizing, does it make sense for them? I don't want to name obviously things, but if you have huge loads of consumers coming on your platform, people start thinking, okay, I have consumers, why can't I sell them an insurance product or a bank account or a credit card, right? Now, it is as easy as saying a person is coming to, and I'll be very honest, taking a motor insurance on my platform, which is a compulsory product, and I'll also sell a health insurance to him. See, the consumer, and being insurance products, right? But it doesn't work like that. When the consumer is buying a motor insurance, he's in a very different state of mind. Probably he's just thinking one tick box on a regulation piece so that he doesn't get fined or he just gets his car registered, right? Similarly, on the embedded finance, as Arjun also mentioned and we were speaking, I believe the most important aspect is, does it help your core business? I believe a lot of businesses have a lot of consumers but do not have revenue, right? So they eventually land up, okay, let me see what I can sell to them and make money out of it, right? And when you start to do that, it probably can work for very few, but it's not going to work at large. So I believe if you want to have an embedded strategy, the core aspect is, how does it help your core business? You have consumer data, don't think that you can do everything with it. That is what we believe. Yeah.
Fantastic.
Yeah, let me try and bring it to life, right? So great point. So I'm going to use 2 examples, right? Because I think the power of the examples are great. So I'm going to use IKEA as one example, because I actually worked with IKEA and we launched, BNPL for IKEA. And our logic was very simple, right? So IKEA makes kitchens, right? I just want to ask, how many of you have an IKEA kitchen? Right? So we've got a few people. But I'm sure people who have looked at kitchens would have definitely visited kitchen. Conversion rates for kitchen and IKEA, right, are relatively high, but it's not a cheap product, right? It starts at about $5,000 just using a common number. Apologies, it could be a bit cheaper, but I'm not talking. What we actually realized was that a number of customers would typically use their credit cards and then use the EPP on the back of their credit card to buy kitchens. Now, 3 issues with that. One, not everybody has a credit card, right? Secondly, a lot of people have exhausted their credit card limits, and actually using EPP doesn't take away from the credit limit, right? So what we said is, why don't we actually offer buy now, pay later, right? And actually have the people pay their down payment on their credit card, which allows for a credit check, so there is a certain amount of proxy credit worthiness. And we actually saw an immediate uptake in terms of people using BNPL. Now, it was completely responsibly led because we were not giving money to anybody and everybody. We worked with a professional third party. We didn't create the product ourselves. But there was a core reason why IKEA, which is actually an incredibly careful organization, and I think all of you have dealt with IKEA in different parts of the world, launched BNPL. It added value. So that's one great example, right? Let me give you a second example where something which was brought in for core has now become a bigger side of the business. I'm sure you've all heard of Shopify, right? So Shopify allows a number of small businesses, even large ones, to go direct to consumer on e-commerce, right? The thing is that Shopify actually is in an incredibly competitive environment, right? You can switch platforms very easily. So once you get a customer onto your platform, you've got to immediately get them hooked on to incremental products. What they realize through their data is that the majority of the people who actually operate off Shopify are micro and small businesses. What do micro and small businesses lack? One, time. Time is their greatest asset. Secondly, they invariably land up spending a lot more on financial services products than everybody else. So Shopify, with the partnership of banks, and I'm assuming Standard Chartered, Goldman Sachs, so on, Citibank is one of them, launched Shopify Capital, right? And started offering not just payments, which is normal, which anyone would have offered, but a number of value-added products. As of now, please don't quote me, but because you can actually go check it out, 70% of the income that Shopify actually derives is from embedded finance products, which is not a core product. So when someone asks me, what's your favorite fintech in the world? My answer is Shopify, right? So that's kind of, I hope I sort of brought that to life for people in terms of the power of how embedders can use it. Yeah.
Absolutely. I like the way you brought in data as an example, and thank you, Neeraj and Arjun, for giving why somebody gets into embedded finance. I think the next logical question for me then is, okay, what are the 3 or 4 ingredients that I as a company should have if I feel I should be getting into an embedded finance? So what's, from switching on your consultant hat, what would you...
I was going to put Kelvin on the spot for that question because he's that. Okay, so I think there's a number of things, right? So I think you need to understand your customers. I think that's the number one thing, right? So you need to have a certain amount of understanding of who you are offering these products to, right? Secondly, you have to have what I call the right to play. And I think that was your point, right? And if I'm extending your point, if I don't have the right to start offering current accounts and savings accounts because I'm selling furniture, right? It sounds bizarre. It's got nothing to do with your brand, but it's a little bit like, if McDonald's starts selling you mortgages tomorrow, you might like McDonald's, but are you going to go buy your mortgage from McDonald's? Well, I don't know. I wouldn't, but I think the vast majority of the customers. So there's an earn and right to play. Thirdly, it's very critical that you have to unlearn a lot of things that you think you know, right, about financial services. And I think that's the problem with a lot of the embedders. We believe we know financial services, right? We need to unlearn a lot. And fourthly, find yourself a very good financial fintech partner, right? Because you cannot build what is required to be built in-house in the speed, the flexibility, et cetera, yourself. So be a bit humble. So my words are humble, unlearn, earn the right, and know who you're talking to. And I'm sure there are others which I've forgotten, but I don't want to hog them over.
Let me take a stab at this one, right? So there are 2 statements I want to make, and then I want to agree with Arjun on something and vehemently disagree with Arjun on something, sure, which is fantastic. The first statement is there is no embedded finance if the provider of the financial services and the embedded upfront doesn't come into an agreement on the value proposition to the client. Let's be very clear about that. It is not about shoving a deposit account or a charge card or a credit card in the face of an existing ecosystem with users on it. It doesn't work, right? Co-branding and the low conversion rates on co-branding have demonstrated that across time. Number 1. Number 2, while we talk about the embedders and why those companies want to move into embedded finance, perhaps take a step back. Have a larger picture around it. Embedded finance, and this is the reason when I pushed it for Standard Chartered, I called it Nexus, is this. It actually works out for everyone in the value chain. What do I mean? Let's look at it from the perspective of the bank. The bank struggles to acquire customers at massively low cost and at high ROE. it struggles to extend lines so that it access those customers because banks are terrible at customer experience and sales. And this business model allows banks access to those customers at scale with the right partner to be able to bring them on their balance sheet with next to no cost of acquisition. Number one. Two, why does it work for the embedder? I mean, we've done a lot of this conversation, but basically, if my first statement holds true, that the co-creation of the value proposition to the customer is tight, what you have is you create an ecosystem whereby the capabilities provided to the end customer, either a small business or a consumer, creates the ability for the individuals to continually access those systems. So from an embedder's point of view, one, yes, money is great, right? Or some additional revenue is always fun. But what happens is you create let's say you're an e-commerce platform or you're a Policybazaar, you create a situation whereby individual users or businesses need to come to your ecosystem to start looking at their balances or looking at their charges or looking at what they've done on your platform. Guess what? Your number of visits into your ecosystem from once a day or once a week becomes twice a day, 3 times a day, 4 times a day. Now, each one of those interactions generates data for that particular embedder, and what you can do with the data in terms of not just monetization, but a better customer experience becomes quite limitless. 3, the third player in this entire value chain is the regulator. People tend to forget. Yeah, it's huge. The regulator could crush your business tomorrow, right? If they wake up and then decide something is wrong and suddenly a note is issued and we're all going to have fun with our lives. Right, we've all scrambled. We've done overnight runs on this one before. But here's the thing. In a truly embedded finance setup whereby there is good co-creation and collaboration between the financial services provider, the regulated entity, and the embedder, which is a non-regulated entity from a financial services standpoint, guess what? There is no requirement for a larger framework for the regulator to try to regulate the embedder, which is what a lot of regulators scratch their head about. How do I stop the large e-commerce platforms, the social media platforms, or how do I oversee how they get into financial services? In this particular setup, it creates a situation whereby there's no real change in the framework because at the end of the day, the bank is responsible, or the financial services institution is responsible for the establishment and the process as well as the delivery of the consumption of those financial services. Now, sorry, this is a little long. I'm going to just go straight with what I don't agree with Arjun about. Now, Arjun says you won't take a mortgage loan from McDonald's. I disagree. What happens if that mortgage loan is based, and the interest rate on that mortgage loan comes down by the number of times you eat at McDonald's a year? You create a real value proposition about revisiting McDonald's and consuming McDonald's core proposition, but get a benefit from your financial services product. Now, I know it may seem crazy to you guys. I mean, look, we're all over 40, right? I mean, I am. It may seem crazy, but who is to say that that does not work? Because honestly, one of the partnerships that we are putting together in Indonesia is a deposit account that pays you a higher interest rate the more purchases you make on the e-commerce platform. Guess what? Purchases on the platform went up 3 times. So, don't know. I would vehemently disagree that McDonald's offering mortgages is not a thing to do.
Yeah, so I don't want to take again my time. I think what I like about it is that none of us, and I apologize, none of us hold the monopoly on so the intellectual. I guess there is no intellectual monopoly on a topic which is so embryonic. My view here is earning the right, and I think if McDonald's is not the right example, that's fine. I think my view is you've got to earn the right to be able to sell a product which is not what you're known for or core to. That's how I see it today, right? Maybe 5 years on. I think McDonald's could do a great job selling health insurance, right?
Probably. Or that might kill their core business, but yeah.
Great. So, Kelvin, you specifically, sort of touched into 2 very interesting elements. One is the role of the financial services provider and the regulators. I'll come to the regulators later, but the financial services provider plays a significant role in effectively enabling embedded finance. And we have seen the full spectrum, right? Arjun touched upon the need of some of the local players over here to why should I even get into it, to challenger banks and to some large players who are selectively getting into some of these. So if there is a bank that is looking into get into this space, what is your view in terms of from their strategy point of view? What should they be thinking about? Why should they be thinking about it in the first place?
So that position, very much consistent with my last panel. I think the answer is that depends, right? So if you are a big incumbent bank in a single country, let's say you are a big incumbent regional bank, but you are big in, say, the UAE, but small in Egypt, then it becomes both a defensive and an offensive strategy. Offensive in Egypt, defensive in the UAE, because look, if you are a second tier, third tier bank with 5% or 3% market share, embedded finance makes a lot of sense for scalability. And an incumbent bank who is not doing it may think that their lunch will be eaten over time. Now, to be honest, if I were a big incumbent bank in a single country, I wouldn't be the first mover in this space. I would say, let's take a look at the challengers. If they move into embedded finance and it works, I will be a fast follower. I'll be first to number 3, right? Because after I will be able to defend it anyway. However, if it is an offensive strategy, then you have to be first in market, because then effectively, first 2 players will pretty much dominate the embedded finance landscape once you tie up with the 3 or 4 largest ecosystems in the country. And very seldom do you get new ecosystems coming up that become, there'll only be 1 or 2 e-commerce players, 1 or 2 social media players, 1 or 2 travel players, wherever that may be. So yeah, it will depend from player to player how they do this. Now, what should they take into consideration on the strategy? One,
sorry, just before getting into that, when you look at, you very nicely spoke about where you are, if you're the first or the second or the third or the fourth. Now, from a bank's point of view, are they trying to catch up with the consumer base? So that's a B2C proposition that they're trying to get into? Or are we looking at banks coming in to say, you know what, I don't really need the consumer data, but I want the ecosystem player as a client, and therefore the B2B angle to get in. Which one do you have in mind?
I think the bank can play on this, because the solution will be effectively the same. It is a B2B2C and a B2B2B mode, because all ecosystems have both buyer and seller pretty much, depending on how you define it. E-commerce definitely, even travel and so on and so forth. So from my perspective, if you go down this path, you are committing to a B2B2C and a B2B2B strategy. For sure, 101%, which changes, which is what I was trying to get to, which will change completely the way you assess risk, completely the way you assess third-party outsourcing, because depending on who your partners are, some parts of the process may or may not be outsourced. It will completely change the way you think about how you actually engineer a partnership. Previously, banks are used to co-branded cards, relatively simple. A sign-on, you go to the site, you say, I want to sign up for ABC card. They'll send you to the bank's website where you fill in the form and so on. Not in the embedded finance use case. In the embedded finance use case, you get instant access to data. Theoretically, you say, yes, I want the card. The card is branded in the partner's name. And you say yes that the bank can access all my data for underwriting, onboarding, all of that stuff. It should be completely seamless now. That integration becomes a massively complex piece of work.
And that's the connect I want to get. That's the theory. What's your experience in terms of actually trying to do this with banks?
I believe, as Kelvin and Arjun said, banks are at all over the spectrum, right? Some banks are taking it on this stride and they're really working on. See, if you look at embedded finance, one thing is very important is your core. How do you think as a core, as a bank, what is your core strategy? And probably you need an external help on that. What Arjun mentioned, Kelvin, his company helps you do that. See, if you look at it, the banks here, they have enough business, right? I don't think so there is enough threat or enough urgency to change things. And as a result, whatever project you pick up internally at times, by the time it sees the light of the day, you're already behind. And that is where you need to partner up. And certain banks here are doing that. Like they're creating sort of a fintech startup lab inside the bank ecosystem where they will partner with fintechs or companies and probably pilot or do a beta on products, right? But having said that, if you look at a very basic thing in the region, at least on a digital side from a B2C perspective, I can comment a lot more on that. how many people here can genuinely go online, get a instant credit card or open a bank account? Probably in last 12 months, now you could have 2, 3 banks. But if you go 12 months behind, no bank, right? Now, if you are at that level, then for sure embedded finance cannot be your priority, because embedded finance rests on a lot of other elements, right? So what we are seeing is at least banks have started doing that, and I believe the first and foremost piece is how do you make it a lot more easy for your own consumer to access your products. If first you can do that, I believe then you can think about embedding your product somewhere else.
So, Neeraj, let me take a slightly more nuanced stance on this. The way I think about it is that you would use embedded finance as a business model to accelerate the capability of the bank in this regard. Because if you're trying to fix the BAU mentality and capabilities of the bank, that's going to take a much longer time.
Absolutely.
Yeah.
So what I want to add there is, so that is where the strategy comes into play. If you're going to adopt the same strategy on how you build your consumer experience, the same thing is going to ride on building the embedded. That's not going to happen. For that to happen, your core needs to get better. And that is where an external party comes in.
So let me try and use some numbers here. So I'm going to support the arguments here, right? Although Kelvin's not been nice to me, but I'll still be, right? So let's break it down. So there are 2 points: burning platform, and the bigger players are slower to move, right? So give you a bit of numbers here. B2C commerce globally is 24 trillion, right? I could be off by a trillion here or there. B2B commerce is 120 trillion, okay? So it's about 5.5, 6x. Most of your big banks make their big money out of the B2B part of the world, right? Although the B2C actually is high margin compared to B2B, unfortunately, because the denominator is smaller, you multiply, the number goes, right? So embedded finance largely lives in the e-commerce world, right? Largely, I'm not saying entirely. E-commerce penetration is 20% of the 24 trillion and 5% of the 120 trillion, right? So it all of a sudden becomes smaller. So the burning platform question has been answered, right? At this stage, embedded finance is not disrupting to the extent that it's hurting you, right? I think what happens is once the challenger banks or fintechs or neobanks or super apps or whatever you want to call it start going after the B2B segment, the burning platform will catalyze naturally. You will start seeing the bigger players get into the game, and you will actually see that embedded finance will become, as Kevin said, another business model which allows you to seize the opportunity. And I go back to the Shopify example as a great catalyst, because if you see, Shopify actually partners with all the big banks, the Bank of Americas, right, the Citi banks, and the so on and so forth, because they're disrupting the B2B side. And the banks are saying, well, hold on, if you're getting disrupted out there, we want a piece of that action, right? So we'll offer our balance sheet if nothing else, right? And Shopify can do the middle place. So I think I'm confirming, but all I wanted to do was bring it to life with some numbers with that, right?
See, I wanted to add on the Shopify piece. If you look at the core aspect, why they went into it, the core was how do more consumers come to my platform, start using my services. And as a result, you went to the whiteboard and thought, okay, what is the burning need for the consumer who's using my services, right? Eventually, it became a bigger piece of their revenue. But if you look at it, it somewhere starts from, yes, what my core system is, which has become a hygiene now, probably a hygiene, and the revenues become the other stream. But it started from there.
I think the Shopify example is awesome. I think it should ring a warning.
Thank you for agreeing.
I agree with you a lot, Arjun. Just on LinkedIn. Anyway, I think the example is awesome for a very, very specific reason. It should sound a warning call to banks out there. Now, if you let Shopify get bigger and bigger, or the likes of Shopify get bigger and bigger across the world, you are going to, at some point, be relegated to be a dumb balance sheet. So how you want to engage embedded finance as a dumb balance sheet, which is simple. It's an API layer on top of your legacy stack, and here you go. Take my balance sheet and go for it, and then I'll make a margin on providing those services. Or you create the capability where you are the one providing the services, you dictate the terms, you create the opportunity for the embedder, and you are no longer a dumb balance sheet because you are not the ones just providing a balance sheet. You're also running the customer experience, you're also running the servicing, you're also running all the engagement on the platform. I truly believe that the banks that move first and fastest, at least the first 2 or 3 in each market, has the opportunity to become I'd say the central nervous system of this data and become real trustees of data, not just the trustee of a balance sheet.
Can I add something to that? I think it's a very interesting, very, very interesting point. And there are bankers out here, right? So there's another clickbaity term which keeps doing the circle, beyond banking, right? To me, any bank which is looking at this graduation from going from embedded finance to becoming an ecosystem player, I think embedded finance is a great step towards that ecosystem play, right? Because if I take the thesis that, you know, Kelvin is presenting, which is banks can build this themselves with partnerships, right? And they don't necessarily need to be dependent to a middle layer. They, in effect, start creating ecosystems. Great example is Australia, Commonwealth Bank, and how you actually can get a mortgage, right? If you take the Commonwealth Bank app, and I'm sure it's been updated since the last time I was in Australia, it's been a while, you could practically take a photograph of the house that you want mortgaged, right? And that app takes you through the entire journey in terms of what's the asking price, whether you are qualified for that mortgage, what would that cost you, which agent is involved in the middle, et cetera, right? Now, the vast majority of those steps are very typically non-banking, right? Taking a photograph with your banking app, you know, is not something banks want to wake up to every day in the morning. They're obviously working with partners. So I think the potential of embedded finance, that's why I keep saying, is tremendous because it is a stepping stone towards banks really going beyond banking, not just saying we sell a credit card with some discounts on restaurants. Nothing against discounts on restaurants, right? But that's not ecosystems for us, right? Sorry, I interrupted.
No, I think you brought it all very well together, and the points that you guys spoke about, right? So there is the dumb balance sheet, which could be there. There is the whole ownership of the client experience, the data, and finally creating an actual ecosystem and going beyond banking. But I guess overarching all of this for a bank is the regulator, right? So let's bring them into the conversation. And what has your experience been in terms of the role that regulators are playing today, both in terms of facilitating this move from banks or actually restricting, almost intimidating the banks from making that step forward?
Okay, this is my personal opinion. Let's be very clear about this. The regulator is not interested in screwing the banks. Nobody is. The regulator is interested in protecting the users. And when I say users, it could be small businesses, it could be corporates, it could be end consumers of the country, right? Absolutely the right thing to do. And my personal experience has been that more and more of the regulators in this part of the world and in Southeast Asia, I can't say much for China and North America, having not done anything there, are increasingly progressive to the idea. In fact, I feel that more people believe that banks are probably better trustees of data than pretty much any other player out there. From a security standpoint, from the ability standpoint, from a balance sheet standpoint, to be perfectly honest. So I'm seeing an increasing progressiveness from the regulatory angle to say, explore new business models, explore business models whereby data becomes part of the, I guess, live stream or bloodstream of the ecosystem and how it works. But please ensure that you adhere to the requirements of these particular security requirements, the security views of cybersecurity requirements of the bank. Please ensure that you know where the opportunities for fraud are. I mean, the usual. Nothing changes from that. On the flip side, I actually feel that the banks are the one holding themselves back. with the most conservative possible interpretation of what the regulator is saying. And in most cases, I think it makes a lot of sense for the bank to say, if there is a memo or framework around this, draw out and draft what you want to do and engage the regulator and say, this is what I want to do, what do you think, and where do you think I need to make changes, as opposed to saying, no, the regulator is definitely saying no to this, and your compliance department spend the entire day sitting around a fireplace saying no to everything.
So
No,
I would want
sorry, I really like the soundbite. I mean, this is probably the best pro-regulator soundbite I've heard in a long, long
Wait
time.
till I come. I'm very bullish on that, but please.
So I wanted to add on that, right? What he mentioned about the banks limiting themselves or from a regulator. Please understand, from a regulator, as Kelvin said, their idea is to protect, right? And for anything which is as big specifically as financial services, you will take time to move. You will take time to move. Let me put it, any startup which when it starts, obviously it's a lot more agile, right? Probably when they have numbers on their, or their incomes are increasing, if they want to change anything, they will spend a lot more time on it. Now, please consider the regulators to be that, right? You have an ongoing business which you need to protect, and something is coming to disrupt or has a new thought process around it, you need to give them an understanding, but you need to engage with them. I believe if you look at any fintech which starts, it also goes through the regulation. But it takes a view of regulation probably a lot more aggressive than probably an established player. That's about it. But I'm very sure any fintech or any startup which wants to operate in a regulated environment might not be regulated themselves, but they definitely go through the regulations. And they take an aggressive view. Now, whereas an established bank, what it does is, it takes a view, no, right? And that is where I believe they stop thinking and stop pushing the boundaries.
So Arjun, before you go, can I add one sentence?
Please go for it.
I think banks or banking and financial services in general tend to overstate the burden of regulations on average. We are different. Banking is different because we're so heavily regulated. So here's one of the first statements I made when I was in payments on the group product team. Kartik Taneja somewhere knows this. He was in the room when I made this statement. If you think banking regulations is tough, try making milk powder, guys. Because if the bank crashes, people lose their money. Yeah. If the milk powder goes wrong, babies die. So seriously, I think we give too much credit or burden to ourselves from a regulatory standpoint.
So I guess, I'll try and add to these guys. It's hard to do that, but I'll try, right? So firstly, thank God or whoever else you believe in that regulators are cautious, right? They have a responsibility towards the wider economy. Second point, guys, these are not the regulators as we, or at least, for our age, when we read about regulators who were basically the custodians of monetary and fiscal policy. These guys now are market makers, right? You have public infrastructure, public goods, you have innovation labs. Regulators now are a very intrinsic part of any catalyzation which actually happens. They're not necessarily deterrent. It is the right thing for them to do is observe, as they say, it takes 9 months for a child to be born, right? So it takes a few months for a regulation to be born. So I think it's a good idea. Let's not expedite it. Now, let's come down to why I think I'm bullish on regulators and embedded finance. Financial inclusion. It's one of the top agenda for regulators world over. Embedded finance has proven itself to be a great catalyst for financial inclusion. Bringing greater access to small businesses, which are the power engine of any economy, right? Most regulators want to power that. Embedded finances, again, proven, and we've talked about Shopify to, Kingdom Come, and Shopify is not the only example. Southeast Asia has several examples, India has several examples, the region is starting to have examples. Number 2. 3, they want to increase what I call innovation in the financial, they want to catalyze innovation in the financial services sector, but intelligent, cautious, sensible innovation. They don't want mavericks, they don't want cowboys, right? But they are keen to drive that. And the fourth point, very correctly, as you said, let's be honest, guys, banks were created by regulators. You guys never went and said we want banks, right? There was no other way for banks to basically implement their fiscal and monetary policy, largely their fiscal policy, without having banks. So they are there to, I wouldn't say protect, but to ensure that the banks continue to work like that. So embedded finance, and I'm very bullish in this region. I work with a number of regulators. The fact of the matter is the biggest challenge for me, and I'll leave that at the challenge, is not the financial regulator alone, but it's the inter-regulatory alignment that needs to happen for embedded finance to work. Because your embedded could be a telco, your embedded could be a retailer, your embedded could be a car company, et cetera, which are also regulated. Yeah? So that's the point. But I'm very, very bullish that I think the regulators get this. Yeah?
I think we are just about 30 seconds on, and we have tried to cover in this 45 minutes the why of embedded finance, the how, the what, and the who to some degree. Now, as one statement from all of you, what is it that you would like to leave the audience with as they think about embedded finance from their perspective? One quick statement each.
I believe Arjun summarized it very well. It is here to stay for sure. How it evolves, times will tell.
I think it is one of the future business models of banks. Some banks will do it, some banks won't do it, but it will definitely be here, and I'm very bullish about it, like Arjun says.
So why don't we open it up to the audience,
Yeah.
right?
So, I mean, we have some time. Any Q&A, any questions that the audience has? All right, we already have some hands over here.
Sorry. Yep. Hey guys, Jay here. Great discussion. I actually agree with you, Kelvin, about the banks will be the winners in this if they are able to do this right. But I guess my question is this: in the position where banks, if they are in a leadership position and yet they're not interested in doing embedded finance or getting into the marketplace, isn't the idea of a cheaper cost per account, new acquisition or new channels of acquisition, how far does that go to help them get out of bed, even if they are leaders in this space? Because I think one of the biggest problems banks have is acquiring new customers, acquiring them cheaply, acquiring customers outside of their traditional acquisition channels.
I think the cost of acquisition is but one element of it. It's a great soundbite, and everyone goes wow when I say the average cost of acquisition in Indonesia is $1.45 per account, which is unheard of. Globally, the average is $120, right? It's awesome. But at the end of the day, you need to know what bank management is incentivized by, right? It is incentivized by return on tangible equity, right? It's incentivized by operating profit, which is a subset and a contributor to return of tangible equity. And also, you need to understand where they are in their process. Is it a new bank management team that has a 5-year runway, or are they retiring next year? Now, if they are retiring next year, I think you can stop having this conversation because nobody is going to take that risk. Right? If they have a 5-10-year runway, it becomes a lot more interesting as a conversation. So I would say, and I know Arjun hates this, but it depends on a lot of factors. The headline is the CAC, because any retail bank here, I'm happy to be corrected if anyone has a different statistic, but on average, your cost of customer acquisition is approximately 30 to 40% of your operating costs on a yearly basis. Now, if that disappears, how does that change your return on equity? How does that change your operating profit metric? And how does that change overall what you can do with the savings that you're taking from this?
So I think if I may just add to what, so CAC without talking LTV for me is half the story, right? And I'm sure there, and Policybazaar will give you a master class. You can sit outside and they will, right? So let me give you an example, right? I think we get too obsessed about customer acquisition. So I was in a conversation with a neo-wealth platform in a particular part of the world. It doesn't, but this is a true story. And my first question to them was, how many customers do you have? They said 80,000. I said, wow, that's very impressive for a very short period of time. You have 80,000. I said, are they transactors? They said, well, no, they've just registered. I have 9,000 transactors. I said, okay, so there's 9,000 people who are transacting every month, every 3 months, because you're an online platform, so, online, Robinhood to me is like the most glorified gambling site in the world, right? So no, these guys have transacted once. You've been operating how long? 2.5 years. So, okay, 9,000 people have operated once. So how many people actually operate more regularly? Well, about 3% of my portfolio, right? So I said, can you turn that into value? And he gave me the value. And then we further broke it down. You know what we realized? That actually there were 7 customers who contributed 26% of the AUM, right? So I'm going back saying, I hope you call those 26 customers every day. Because if those guys leave, the 80,000 is no value. So I think, let's not get too carried away with CAC or CAS. Sorry, second question, and then we'll shut.
Hello. Hi, my name is Lee. First of all, thank you for the guest speakers. I am from Huawei Cloud. I am the head of a financial service for our GCC area. I'm also a huge fan of culturenomics. Thank you, Arjun. Yes, so I actually have 2 questions. One is that I heard this saying like, nobody needs bank, but everyone needs an entity that provides financial service. I want to take a quick reaction from all the guest speakers. And also my follow-up question is, I always think that there will be like some type of cooperation between the traditional banks and also these financial service providers, so we call the Fintech. So like, what do you predict in the future this cooperation or the synergy will be? Thank you.
That's fair. You guys. So as the first thing, what you said is, people need financial services, absolutely right. But if you look at it, they essentially do not need banks is because still the mindset or in the consumer mindset, bank is one big branch where you go stand in a queue, right? But now if you look at the new age banks, for example, the VO, which is the Abu Dhabi-based bank, I believe everybody, at least my experience has been great in terms of opening an account and putting in my money. Probably they're giving the best interest, probably that. But I've not used them for traditional services in terms of transaction and all, but it looks like it'll be right there, right? But if you look at it, I'm not treating VO as a bank per se. It's more of a financial service provider to me, right? And that is how the consumers are seeing it. And that is why if you look at least this region tried in a big way, but I don't know if I call it a success or not, but majority of the banks here launched a digital bank. I don't know where it is as of now. Does it really contribute to their percentage in terms of revenue or anything? But yes, banks have started thinking, and from a consumer perspective, they started interacting with banks more of financial services. The other element that you said, how do fintechs integrate with the traditional players? It's all about engagement, right? As Kevin said, Arjun said, we engage with them a lot. Please understand where they're coming from. If I was to integrate with a traditional bank or an insurance provider today, and I go to them and tell them, okay, this is what I need, you better do it. They're like, buzz off. Like, sorry. So what we've done at Policybazaar, and probably we've been very successful at that, is we've always tried to understand the pain point of the manufacturer and look at from his or her point of view that why is that person not wanting to do this, or what is the obstruction to it, right? And if you address that, I'm sure you can get across.
Sorry, he wants to answer that question.
No, just one statement. I am the doom and gloom soothsayer for fintechs, guys. I believe that the banks are here to stay. I believe that once any fintech gets to a certain amount of profitability and scale, the banks will start to eat it. And it happens, and they will come in. It's not too difficult for the banks to do that. The only fintechs that escape this are those that make it very big, very fast, that the banks can no longer purchase them, but which is very unlikely. Or MasterCard or Visa, one of those guys will buy them.
They don't want you to ask the question.
Hello. No, in fact, you were pointing towards Kelvin, but my question was directed more at you. So, very interesting session. And Arjun, you mentioned about those 4 points. One of them was financial inclusion. Having been in banks and having been in the fintech side, I'm with a company called Credor, which is a fintech startup. So what I find is that, let's say B2B, you said $120 trillion. The funding gap is around $3 trillion. It's actually increased, right? So the MSMEs are not getting the credit from the banks. What I find is that they're getting a lot of lip service because everyone wants to do for MSME at high interest rates, low quantum, and so on. So when we talk about supply chain finance as one of the solutions, the deep tier finance is something that we feel is the need of the hour. But beyond the level 1, level 2, banks are not prepared to go to the level 2, level 3, 4, and beyond. So I don't know how this banks are going to actually go ahead and see that enough funding is made available to the last smallest supplier who is there in the supply chain. So I want your views on that as to.
So, sorry, obviously I can't warrant a view on behalf of the banks. But if I've understood your question, you're saying banks aren't that excited about micro and small businesses, right? I'm simplifying the answer, right? So I agree with you. They're not, right? The micro small business issue has not existed from yesterday. It's existed from time immemorial, right? So it hasn't, right? My argument was from a regulatory perspective. The regulators are increasingly, and the governments are increasingly interested. Vision 2030 clearly predicates that the small and medium industry in Saudi Arabia has to grow, right? So from a regulatory perspective, the government perspective, there is a lot of push. Now, you'll see mechanisms will come up, guarantees will come up, right? Securitization products will come up, right? Where the regulator might take a stance on it, right? There are national development funds which might step in. So I think that's a regulatory perspective. But let me also come from a bank's perspective. As Kelvin just said, if someone else comes and starts to win in that space, right, you will see that banks will respond. And I'll give you a very good example for people to look at the UK. There's a bank called Oak North, right? Oak North focuses on the SME segment, right? And they are arguably, for me, one of the best fintechs in the world and one of the only new banks or digital banks which make money. By the way, just 5% of the 475 digital banks make money, right? So, and they're one of them and they make a fair government. The more interesting part of Oak North is not the fact that they make money. They've actually started selling their technology platforms to other banks who wanted to get into the space. And if I'm not wrong, and my data is way out of date, the last time I met their founding team, they had already got 18 banks in the US using their platforms, right? So I think that burning platform or that opportunity, as soon as people start seeing it, you will see people shifting towards it. But as I said, you got the whole ecosystem which needs to shift, right? This is not a flick of a thumb which will happen.
Fantastic. Thank you so much for an exciting and engaging conversation. I guess the questions from the audience says it all. Thank you, Neeraj. Thank you, Kelvin. Thank you, Arjun.
Thanks, everyone.
I don't want Simon to be the only thing out of the picture. Thank you so much. Pleasure. All right, so we're on to the last session of the day. So take your seats for our closing session. We've spent the whole day talking about embedded finance, and we're now going to look a little bit into the future. Many of you will have heard about the Nordic region and its success at driving digital identity, at cashless, and obviously the home of some great digital companies like Spotify. We're privileged today to have someone that has moved to the region relatively recently, has worked in embedded finance, but has come from Scandinavia, from the Nordic region, and is going to talk a lot about the future of embedded finance and open banking. So, Michael, over to you.
So am I audible? Perfect. So thanks guys for sticking around. This is going to be just as much a matter of looking beyond as it is going to be a recap of all the excellent speakers we've had here today, the panelists. All of them have been looking to the future. And so I asked AI, everybody's talking about AI at the moment, to spend a bit of imagination about picturing the future of the bank. this is what it came up with. Obviously, this is a brick and mortar bank. I'm sure that the banks will survive, as Kelvin from audax also said earlier. They're going to survive. They're going to flourish in this. Because if we look at the predictions, and I'm going to take a